while everyone else is paying 6.5% for mortgages in 2026. Smart buyers are literally taking over someone else's 3% loan from 2021 and pocketing $800 every single month. It's called an assumable mortgage. And it's completely legal. Here's how you steal these rates. Picture this. Your co-worker just bought a house and he's paying $3,200 a month for his mortgage. You buy the exact same model home next door, but your payment is literally half that. $1,600. That's not fantasy. That's what happened to one buyer who took over a VA loan at 3% instead of getting stuck with today's rates. Right now, mortgage rates are hovering around 6.5%. But here's what blew my mind. About 6 million homes in America have assumable mortgages with rates below 5%. Most are sitting at 2.75 to 3% from the pandemic era. The monthly difference is staggering. On a $400,000 home, switching from 6% to 3% saves you $350 every month. That's over $4,000 a year, or $125,000 over 30 years. Here's the kicker. 98% of sellers don't even know their mortgage can be transferred to you. A recent search on Rome showed 433 homes in Houston with assumable mortgages under 3%. The same search on Zillow showed only 3. Because sellers don't know to advertise it. So which mortgages can you actually steal? Only government-backed loans. That's FHA, VA, and USDA mortgages. Out of 52 million outstanding mortgages, about 23% are federally backed and assumable. That's roughly 12 million homes. VA loans are the golden ticket here. These often have the lowest rates. And here's a secret most people don't know. You don't have to be a veteran to assume a VA loan from someone else. The assumable mortgage market exploded 139% from 2022 to 2023 as buyers discovered this hack. But there's one massive catch that stops most people cold. The equity gap. Let's say someone bought a house for $500,000 in 2021 with a 3% mortgage. Today that same house is worth $700,000. You can take over their mortgage, but you need to cover that $200,000 difference in cash. That's on top of whatever they've already paid down on the loan. For a typical buyer, coming up with an extra $200,000 in cash is impossible. But smart buyers have found 3 ways around this. Option 1. Negotiate seller financing, where the seller carries a loan for part of the equity gap. Option 2. Get a second mortgage to cover the difference. Option 3. Use a combination of cash and creative financing. Even with a second mortgage at 8% to cover a $200,000 gap, you're still saving over $400 a month compared to a new loan. Your blended rate works out to about 4.6%. Way better than today's 6.5%. Here's how to find these deals right now. Use Rome.com, the biggest platform for assumable mortgages. They've identified properties where sellers don't even know their loan is assumable. You can also search directly with real estate agents who specialize in assumptions. One buyer went from number 1500 in line for a popular listing to number 1 after hiring assumption specialists who knew exactly how to structure the deal. The process takes 60 to 90 days and costs about $3,000 in fees. But you're saving hundreds of thousands over the life of the loan. The math is so good that buyers are offering above asking price just to get these assumable loans. This is your reminder that the best financial opportunities are always hiding in plain sight. Most people don't know about assumable mortgages. which means less competition for you. Follow for daily money tips that actually work.